If we now have a look at the statement of changes in equity, and this is an extract, it's not all the columns, you can see two of the columns there, the retained earnings column and the mark-to-market reserve on equity instruments column. So in retained earnings every year, the profit for that year will be included. So for the 2019 year, then for the 2020 year, for the 2021 year and the 2022 year. So it accumulates. It makes the retained earnings balance more and more and more. It was a profit for the year each time. There was never a loss for the year. Now, if we have a look at the column mark-to-market reserve on equity instruments, remember to specify that it's on equity instruments. This is where you bring the OCI that represents the fair value adjustment. So in the first year, which was the reporting period 2019, there was a positive, an increase in the fair value of 10,000. The next year, there was a further increase of 25,000. It accumulates. It's a cumulative. It's a balance. You add it together. So your balance at this point is already 35,000. Then in the reporting period 2020, there was a downwards movement, a negative movement. Any movement up or down goes to mark-to-market. Your mark-to-market reserve on equity instruments can actually be a negative equity item. It can have a negative balance. Then in the next financial year, on the date of disposal, there was a positive movement. And on the date of disposal, it is our accounting policy to recycle the mark-to-market reserve on equity instruments on the date of disposal. What does that mean? It means I move the balance on the mark-to-market reserve. I move it out of this column and I move it into the retained earnings column. This is an accounting policy. You do not have to do this. If your policy was not to recycle, you could leave the balance of 20,000 right there in the mark-to-market reserve column. Then your balance at the end of the year would not be naught. It would be 20,000 and it would stay 20,000. Even though you have sold the shares, even though you have disposed of the shares, the underlying asset, you can leave the mark-to-market reserve on equity instruments. Now, if you only dispose of a portion of the shares, the amount that you recycle, if that's your accounting policy to recycle, the amount will only be a portion of the balance. It won't be the entire balance. You would have to calculate a part of that balance, the part that relates to those shares, that portion that you are selling. Now let's just think about what would have happened if this investment had been an investment in a subsidiary. For the separate financial statements, you would still have an investment in shares. In the books of the parent, there would be an investment in equity instruments. Yes, it gives you control. Yes, it is a subsidiary. But in the separate financial statements, that represents a financial asset that falls in IFRS 9. Now, because usually when a parent has an investment in the shares of a subsidiary, they do not trade with those shares. They want to keep that investment because they want the control. It is very possible that that investment could have been irrevocably put in the category, elected into this category at fair value through OCI. That means you should do fair value adjustments on that investment every single year. So in the separate financial statements of the parent, where they have an investment in a subsidiary, they should actually fair value adjust that investment every single year. That's what this category says. The problem comes in on consolidation. Because if you want to write your at acquisition journal, you need to have your investment at the original cost. Otherwise, the at acquisition journal won't balance. That actually means if the parent did the fair value adjustments for console purposes, you would first have to reverse all the fair value adjustments, get the investment back at original cost, and then do your at acquisition journal. However, luckily for console purposes, the parent has a choice, even though it is an investment in shares and it does fall in IFRS 9 and probably irrevocably elected in the category at fair value through OCI. The parent has a choice to not do any fair value adjustments, to keep the investment in the subsidiary at cost, not fair value adjust that investment, because that makes the console procedures easier. But it's a choice that the parent has to make. So in a consolidations question, we would tell you it is the accounting policy of the parent to keep the investment in subsidiary at cost. That actually goes against IFRS 9, because IFRS 9 says it should be at fair value. However, consoles is an exception to the IFRS 9 rule if the parent chooses that. The parent can choose to hold the investment in the subsidiary at fair value. Then they would have to do fair value adjustments. And for console purposes, you would have to reverse those fair value adjustments before you can even do the at acquisition journal.